Hello everybody, my name is Josh Johnson and I am currently the VP of Investment Strategy on the exec team for the Student Managed Investments Committee. And so today we are going to be covering how to work through, specifically in Excel, a comparable company analysis. This is a relative valuation of a company that allows you to come to a intrinsic value range where you can see whether the price the company is currently at falls within that range to see if it's priced fairly compared to its peers. And so mostly today, again, we're going to be working in Excel. I'm going to pull that up in a few seconds, but this video should be a supplement to your working knowledge conceptually of the comparable company analysis, right? This goes along with the valuation guide. You should really look through that first before you even work through this video, just because we're going to be pretty high level going through the conceptual points, and so if you really have no working knowledge of the concepts, then it's hard to apply it within Excel. And so I would highly suggest working through the guide first, and then coming back to this and working through this. Make sure you go ahead and do that first. And so without further ado, we will go ahead and begin. We can go ahead and pull up Teams. This is where you're going to want to go in order to begin. So when you first come up, usually you pull up the General tab, and obviously we've done this a few times, I would hope, but go to Files, come down here to Graphics, or to Templates and Examples. Then you're going to want to look at Other Templates, and it should be right in here at the top, GCSU SMIC CCA template. Just going to click on that, and that should open up the template for you. Now when you're doing this, it's automatically going to pull up online. So when we're doing this, we don't want to work on the online version. It's very frustrating to kind of look at. It messes up formatting, so you're going to want to go up here to Editing, click on that. If it'll come down when it loads up. There we go. Then you can do Open in Desktop Apps, and then this is going to bring you into Microsoft Excel itself. And so it says Opening. So then this is the template that GCSU uses. So any edits on here are going to affect it in the actual template that is for everybody to see. So what we want to do first is to create a copy of that. So you can go to File, save a copy. I already have created a copy, so I'm going to go ahead and do that. But basically, what you can do is change the name. You want to change the name, or else it won't let you save it again. And then click Save into whichever folder or whatever you want. And so maybe you can rename that like I rename that CCA video copy because I'm doing this for the evaluation video. So I'm going to go and pull that one up. Alrighty. Close the other one. I'm going to also close this right here. Okay, perfect. So now we have this. And so really there are 4 or 5 steps in order to do a comparable company analysis, right? And so what we're going to want to do is the first step is find peer companies, right? So in this case, right, we have, let's see, and also your company, obviously. So today we're going to be working with Capital One is the company we're going to be working with today. So usually for public companies, it's not very hard to find peers. Typically Bloomberg will have that. You can go on the comparable company analysis or relative valuation function in Bloomberg, and it'll give you, I think it gives you really like between like 5 and 10. But typically for this, you only want about 2 to 5, right? You want to keep it a little shorter. You want to make sure the comparable companies are much more similar. So really, what you want to look for in this is going to be companies of similar size, geography, and products, what they sell, how they make money, revenue streams, and then by size, you can think of market capitalization, you can think of revenue, you can think of net income, all that good stuff. How big financially is the company? That's what we want to think of. So for Capital One, their biggest ones are probably going to be your Discover. Probably Visa. Let's think for a sec. One other one, probably American Express. Okay, now that we have our 3 peers, that's the first step, right? You want to figure out the peers of the company. And then the second one is you want to pull financial data. You want to be able to pull the data of each of these companies, right? And so when you're thinking of that, what you can think of is think this data right here, and these first three sections, really, right? That first section, second section, third section. That's the type of data that you really want, right? Looking towards the future, the next thing we're going to be doing is why we need to pull those financials, right? We need to find the EV over EBITDA, EV over sales, and PE ratio for each one of these companies. So EV over EBITDA is going to be your enterprise value, so the value of the entirety of the company divided by EBITDA. So earnings before interest and interest, taxes, and depreciation and amortization. And EV over sales is simply going to be your enterprise value, so the value of the whole company over sales, over revenue. And then here we got PE ratio, the price to earnings ratio, so the price divided by the earnings per share. Or you can think equity value of the company or market capitalization divided by your earnings, your net income, right? So how much is the company's equity worth relative to the amount of money that it earns in profit each year, right? And so unlike a lot of the other valuation methods, we're looking at one time period, right? One time period. What are these metrics? So we're going to be looking at the end of 2023. It's middle of 2024 about now, but we're going to be looking, just for practice sake, at the end of 2023. It's going to make it a little more difficult when you're in between years. You might have to, figure out a last 12 months number, similar thing like that. But for our sake, we're going to look at the end of 2023 as our valuation date. So now, right, we have to figure out the share price of these. And actually, a trick in Excel that you can use is you click on those, and then you go to data. You can click on the stocks function, and what that will do, if it will load, we'll turn each one of those companies that you put right there into a stock and its stock ticker to where you can pull information, right? So here, I want to find the share price of this. What I'm going to do is just do equals, go over there, and then do dot. And then when you do that period, it'll pull up a ton of different things about the company, right? So we're looking for share price. So what we're going to want to do here, and price, right there, boom. And then I'm going to select that, and then toggle down, select down to the next three, and then you can just do Control D. And it will do the exact same thing for every single one of those boxes. So now we have the share price for each one of our four companies. Pretty easy, right? Now let's get shares outstanding. Equals, boom, shares outstanding, boom, there we go. Easy money, Control D again, and then we got that. And now, like we learned in the analyst guide or the valuation guide, market capitalization is just the two previous numbers multiplied together. So it's going to be equals share price times shares outstanding. All right. So here we can see all of the market capitalizations for each one of these companies. And now this is where we're going to want to pull up the financial statements for each one of these companies, right? So here, let's go ahead and do that right now. Beautiful. So now we can find the debt. Now that we have each of these in here. So we have income statement, balance sheet, and statement of cash flows for Capital One. And now we can pull the debt. Debt is going to be just short-term plus long-term debt, and that is found on the balance sheet. So you can do equals, go to the balance sheet, and then we can find short-term debt. Should be under liabilities. So it's going to be under, you obviously want to go most current year, long-term debt, plus short-term borrowing and repos, right there. And then that's how we got our debt right there. So that's our total debt. And then you can actually, yeah, that's perfect. And then we can find minority interest. So again, just do equals and then go into now the income statement. And it's typically toward the bottom. So that's where I like to go. Yeah, it's right here, right under income loss, including minority interest. 0, so you can still select it, doesn't matter. And then we're going to want to go to cash, and so that's going to be on the balance sheet as well. Cash and cash equivalents, most recent year. Boom. And then enterprise value is simply going to be equal to the market capitalization plus debt plus minority interest minus cash. So it's going to be the opposite of probably what you're used to with looking at going from enterprise value to equity value. It's going to be completely flipped. So you're going to add debt and minority interest and subtract cash from that. And now we are going to go to get EBITDA, right? So you can go equals, and you can take your net income gap, and then add back interest, add back income tax expense, and add back current income tax, and then you want to add back depreciation and amortization, which you will find on the statement of cash flows. And that right there, same value because that interest was just a dash. So there, boom. There's our EBITDA. And then revenue, that one will be pretty easy to find. Obviously your income statement. I'm gonna go up here, let's do net revenue. Boom. And your net income equals, that's pretty easy. We just found that right there. Net income gap, got that there. And now you would repeat this for each company. So I'm gonna go and do that. You can typically pull the financials for each one of these companies from Bloomberg, but I am unfortunately not having access to the trading room right now of the summer, and so I'm gonna go and just pull those from Yahoo Finance really fast and then go ahead. So now that we have the data, we have each company's market capitalization, then we found each company's debt taken from the balance sheet as short-term debt plus long-term debt. Minority interest, all these companies, it's at 0. Cash found on the current assets portion of the balance sheet. And then enterprise value taken as market capitalization plus debt plus minority interest minus cash. And that gets you your enterprise value. Again, enterprise value is the value of the entirety of the company. So the value of the company's equity plus the value of the company's debt. And obviously you have to take out cash for that as well, because if you were to sell the business, that cash would not go with you. The debt would come with you. The cash would not follow you there, essentially. And also the cash would be used to probably pay off the debt as well, as much debt as it could. But that's the reasoning for that. Additionally, we found the company's EBITDA, revenue, and net income. EBITDA being found by taking net income, adding back depreciation and amortization from the statement of cash flows under operating activities, adding back the interest expense, as well as the tax expense or tax provision, as they might call it. And so just again, a heads up, I took all these numbers up top for Capital One Financial using the Bloomberg financials, downloaded those. You can see them again right down here to the right of that sources tab. However, because I don't have access to the trading room right now, I don't have the financials from Bloomberg for Discover, Visa, and American Express. However, in most cases, you're going to want to pull those, have them over there as well, up, ready to go, and that's where you're going to pull the data from. But since I didn't have that, I just used Yahoo Finance, pulled it real fast, and got that there as well. So now we're on to step 3, right? Finding the valuation multiples. So finding your EV over EBITDA, EV over sales, and PE ratio. And so if you know what the formulas for these are, which obviously they're in the name of the multiples, this should be pretty straightforward, right? You're going to find each of these values for each of the companies using their financials. So for EV over EBITDA, we're going to do equals enterprise value, EV, divided by EBITDA. Pretty easy, right? And then we're going to go equals, and then we can do that for each one of those companies. So if you want, you can just Control D down on that, and then that should pull that up for you. And then you might actually just fix the, fix some of the borders there. They might be a little funky, but got that all fixed there. Got them all for each of those there. And then here we can find the same kind of thing for EV over sales, except instead of using EBITDA, we're going to use revenue, obviously. So you're going to do equals enterprise value divided by revenue. Easy enough. Ooh, did not mean to do that. Pull that down there using Control D once again. All right, and now onto the PE ratio. So that's going to be price divided by earnings. So, or divided by earnings per share. And so since we don't have earnings per share, we're just going to take earnings, so net income. And obviously you don't want to divide price by net income. You want to divide market capitalization divided by net income, because price divided by earnings per share obviously is just being your net income divided by shares outstanding. So then if you're just using net income, then you just multiply that share price by shares outstanding, which gives you your market cap. So here we're going to take market cap, divide by net income. Boom, got that there. And now we have each one of these multiples. And so what are we, let's talk a little conceptual here. What are we trying to do with the comparable company analysis, right? This is why it's highly suggested to read the conceptual portion before you do the Excel version. Because whenever you understand something conceptually, it's easier to figure it out, improvise, and see what number you need to put where in Excel. So essentially what we're doing is we're saying, okay, what's the value of this company, Capital One, that we're analyzing compared to 3 of its peers, Discover, Visa, and American Express? Well, we need to find out what each one of those companies are worth based on an amount of earnings that they're bringing in. So that's where these multiples come in. What is the value of the entire company per dollar of EBITDA that's coming in? Well, Discover is about 10x that, 10x EBITDA, right? Per dollar of sales that's coming in, they're about 2.7x of sales. And then PE ratio is a little different, but same idea, is how much is their equity worth compared to their net income. And Capital One is about 11.3x their earnings. That's what their equity is valued at. And so what we're going to do is we're going to say, okay, what are these other companies valued at? And how should Capital One be priced based on that? So we're going to have to find a mean or a median of each of these values and use that and then apply it to Capital One's numbers to see what they should be priced at, right? If their enterprise value was based on an average of each of these EV over EBITDA multiples, what would their enterprise value be, right? And so we do that for each one of these 3 valuation multiples, and that's how we get a valuation range. So let's go ahead and do that now. That is going to be the 4th step, finding statistical mins, mean, median, and maximums for each of these valuation ranges. So Excel, very good at this. You can just do equals min, put each of those 4 numbers in there, and you got that. And then you can just Control R that right there, and it'll transfer to the right. And then you can do equals average to find the mean, and then you can again Control R that right there. And then this one you can do equals median, and then go to these numbers. Again, same type of numbers. That's going to find the median of each one of those numbers, and then you can Control R that, and that will shift the formula over. And then you can come in here, do max, same type of thing, same numbers, boom. And then you can Control R that. That is in an accounting form, but we're going to do that in general number form. We'll just do 3 decimals there. That should be good. All right. Now that we have that, we're going to figure out, okay, are there any outliers? Are there any, in here, is there any reason why we can't use the mean, right? Is there any outliers that allow us to not be able to use the mean in one of these? Because if there's one huge outlier, that's going to shift the mean to an unrealistic place where the average really shouldn't, without that outlier, wouldn't be that. So in that case, you might have to use the median. And so let's look at each one of these. Okay, so a 23 might be an outlier. 16 is definitely an outlier here. And these all look relatively similar. So I'll say this, let's use the mean for the PE ratio, since these are all within 15 to under 20 of one another. So control U there. And then these two, I'll use the median. So flexible like that, right? And so now we're going to find an implied EV or enterprise value of our company. So we're going to take, right, that median EV over EBITDA number, and this essentially just now means that the enterprise value, the value of the entirety of the company, is about 10 times that of EBITDA. So now we'll have to multiply that number by our company's EBITDA. And now based on this, our company should have an enterprise value of about $89.735 billion, right, according to this valuation multiple. EV over sales, we're going to do the same thing, use the median, and then multiply it by our company's revenue. And then that's, so we have about the implied enterprise value of the company here, according to the EV over sales multiple, is about $102.328 billion. And then the PE ratio, we can do the same thing, except here, this is the one tricky part, right? The numerator here in the PE ratio is going to be market capitalization, right? When we found the PE ratio, we used market capitalization in the numerator. So market capitalization, again, just a fancy word for the equity value. So what are we going to do? We're going to go to equity value instead of implied enterprise value, right? And then take that mean number, multiply it by net income. We got that there. And then here are these three numbers right across here, right? So we're going to apply, again, our company's debt, minority interest, and cash, put it there to get from implied enterprise value down to implied equity value. So this should be pretty straightforward. Should be the same for each one of those. And then you can just fill in this implied equity value for the PE ratio is essentially just going to be the equity value, and then plus your debt plus minority interest minus cash. Boom, got that there. Now we can do the same thing but reverse for each one of these. So we're going to do that $89.90 billion minus debt minus minority interest plus cash. And then we can apply that formula. So boom, now we have a valuation range for the equity value. And then we can take the shares outstanding, right? So shares outstanding, again, just gonna do that right there. And then you can find an implied value per share range. So we're gonna take that equity value, divide it by the shares outstanding. So our range, essentially, of the company's value is going to be between $117.21 and $240.54. And so now let's talk about how do we interpret this, right? So I'm going to just put the share price down here for ease. All right, so this is our current share price right here, right? It falls on the lower end of the spectrum, and so that's a good thing, right? It falls within the spectrum. So we're saying, okay, we figured out, according to these other valuation multiples, if we had the median or average of our peers' valuation multiples, if we assumed that for our company and on our company's numbers, essentially what we can do there is figure out that the actual price of the company falls within the target price range, which is $117.21 and $240.54. And it's also especially good that it's on the lower end of this, right? Because if your implied value of the company is higher than what it's currently at, then there's that upside, right? There's that implied upside that you have with the company. But if it's below it, then, if it's below the current price, if your target price is below the current price, there's not that upside, right? You believe that the price of the company should be lower than what it currently is, so the stock will go down. However, since it's on the lower end, there's about $100 of extra upside in this valuation range that the company could exhibit. This is a great thing. There's a lot of upside potential in this company, and so that would suggest a buy suggestion, right? So again, remember, this is a good thing. And so this is essentially how you do a comparable company analysis. Now, I know some of the concepts might be a little bit confusing, especially the language like taking an average of a company's valuation multiples or of the peers' valuation multiples and applying it to our company's financials. And it can be a little bit confusing. We're going to get a lot more in depth with that in the guide, in the valuation guide. Explain that means a little bit more, but I was just, today assuming that you guys have at least some semblance of, what's going on behind the scenes. What are the concepts that allow us to be able to perform this valuation, right? And so, again, when calculating these financials, you really want to use the same source every single time for all of these. And so typically what you're going to do is you're going to use Bloomberg, but today, obviously didn't have access to Bloomberg, so could only use that for Capital One. But yeah, those are the 4 or 5 steps of finding valuation range. I believe I said the first 4, but the 5th one is interpreting that value, right? Interpreting what the implied value per share range means, really. And so we came up with the conclusion that this is supports a buy suggestion, and so from there, this is really how you do it. This is different from an absolute valuation where in a DCF or a DDM or a discounted net income, discounted residual income model, figures out an exact price of the company. This figures out a range of the company to see, okay, like relative to everyone around me, how is this company priced? Is it expensive? Is it cheap? Right? And so, given how the rest of Capital One's peers are priced, and given how it's priced right now compared to the rest of its peers, it's actually in a pretty good place, right? There's a good amount of upside. We can actually calculate the amount of potential upside before it reaches that top end of the range by doing parentheses, and then that 240, the maximum side of that valuation range, minus the current price divided by the current price. And it has a huge upside, right? 67% upside. That is how to do a CCA. Again, if you guys have any questions, let me, Jeff, any of the exec board know. We would love to help you guys out. And especially understand it conceptually. If you have a problem understanding it conceptually, that's you can think of that being the root of the problem in your valuation, right? You might not, if you don't understand the conceptual parts, you're definitely not going to understand how to do it in Excel. If you don't understand how to do it in Excel, it's okay if you understand the conceptual parts, because the Excel stuff will come, right? You'll figure that out. Thank you very much. Y'all have a great rest of the day.